Welcome to Daily Rates Live with the Mortgage Calculator. Today we're going to go through some live mortgage rates and then we're going to do a deep dive into reverse mortgages. This is actually something we haven't talked about on our Daily Rates Live yet. This is going to be the first time, so this will be a great training here to go through in a little bit. Before we get into it, though, we'll wait just a couple of minutes to get started here so we can go live on all the different platforms. We're streaming this on Facebook, YouTube, and LinkedIn. So thank you, everybody, for tuning in on all the different platforms and Spotify and Apple Music. Appreciate the listeners out there. We will get started here in just a moment. We put the chat up on the screen, so feel free to drop comments there as you tune in. Appreciate the comments already rolling in, people tuning in nice and early. And as we go through here today, feel free to drop any questions you have as well on reverse mortgages when we get into the deep dive topic here. You can drop any questions you have in the chat. All right, some comments still coming in. Appreciate it. And it looks like we are live on all the different platforms, so we can go ahead and get it started here. Keep dropping comments in the chat and drop any questions you have in there as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender. This specializes in non-QM loans, and what we do every morning on this show is go through some live mortgage rates of how the market is looking, and then we do a deep dive into a different loan topic. Now, today's topic is something new to this show, which is reverse mortgages. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to do a deep dive into reverse mortgages. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and look at the live mortgage rates. So, Nick, if you're ready, let's go ahead and pull up the pricing and see what the market is looking like this morning for some different programs.
All right, let me switch my screen and we'll check it out. So as Kyle mentioned, this is our pricing tool. This will show us the general rates and APR for today. It is October 19th, just after 11 a.m. Eastern. So all of our general programs are live. So we'll set up a basic scenario here to compare across the programs. If you'd like a full loan estimate with a breakdown of all the fees that go into the APR, please get with our team members. We have over 400 licensed loan officers in 24 states for primary homes, and we can do our business purpose in 44 different states. So for today's demo, we'll set up a scenario to compare across the programs. $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment on all the demos. And we'll tell the computer to find the lowest possible rate option with the buy downs. And we'll compare our conforming conventional to our FHA, which is usually the next option that most borrowers want to look at. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional options. We also have VA and USDA. VA is only for eligible vets and active service members. If you are eligible, we can quote it, no problem. And USDA is only for eligible properties. If you do happen to be shopping for one of those, we can quote it, no problem, but we don't do those live. We'll start today with conforming conventional. We'll do a purchase, 30-year fixed loan, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated credit score of 760 and an estimated debt to income ratio of 40. So with these settings, let's check out the conventional options this morning. Ouch. And it keeps going up, right? So every day when the markets go up, unfortunately, the rates are going up as well. So definitely higher than it was yesterday. But we, again, have our cool portfolio option. So it comes in handy when the conventional rates go crazy. So the portfolio option here, it's not technically conforming, but it uses the same guidelines. 7.25 rate, 2.5 discount points and cost, puts the final APR at 7.467. So that's what conventional was yesterday. Now conventional, a little more expensive, 7.49 rate, 2.5 discount points and cost, puts the final APR at 7.716. So good option here for conventional. But as we mentioned in the show, definitely recommend our loan officers and anybody out there shopping, definitely consider some portfolio options as conventional was just a little dramatic with all of the market turbulence. Now, if for any reason our customer doesn't qualify for a conventional, set up the same exact scenario and compare that with FHA is usually the next best option. If our customer has any trouble qualifying, FHA does allow a little more leniency on credit issues, as well as a much higher debt to income ratio. However, we will keep everything exactly the same so we can compare apples to apples across the program and compare APR. So the best FHA options, looks like, again, it went up a touch from yesterday as well, but FHA is cheaper than conventional in this example. 6.75 rate, 2.375 discount points and costs, puts the final APR here at 7.389. So remember, conventional was 7.6 something, or I believe 7.7 something. So FHA is a touch cheaper if our customer qualifies for both. And if our customer doesn't qualify for conventional, fortunately, FHA has a great deal here. This APR does include the mortgage insurance that's required. So definitely some great changes they've made this year. Now, where we love to help our customers is if any other banks or lenders get a customer that doesn't qualify for FHA or conventional, they will have to deny that customer. But that's where we love to present our non-QM options, also known as expanded guidelines, where we have over 5,000 other programs we can help our borrower with. So we'll keep everything the same, except when we choose non-QM, we get a new option here for income. So full doc is 2 years of tax returns. That's what we use for conventional and FHA. So we'll typically choose non-QM to go with one of these other options, such as asset related, business bank statement. The investor options are just for investment properties. Personal bank statement 12-month, that's the most popular program by far. That's what we'll use for the demo. RSU, stated income, VOE, 1099, P&L, all different options. For the demo, we always use the 12-month personal bank statement option here, and that's for our self-employed borrowers. Many times our self-employed borrowers submit tax returns and may have different write-offs or issues qualifying, or may just not quite get enough income using their tax returns. So we'll solve that problem. No tax returns at all, just their last 12 bank statements, to determine a debt to income ratio of 40% in this example, using no tax returns at all, just their cash in the bank statements. So many times our self-employed borrowers qualify for double or triple the income when we use this method and can therefore get the home they really want. So let's check out the rates for our non-QM bank statement options. All right. So this one's the full doc. That's not going to work here. So we have a couple portfolio type jumbo options here. 7.5 rate, 4.625 discount points and cost. Probably a little too spendy, but the computer is saying that APR of 7.688 is technically a bit lower than the next portfolio option here, which would probably be the more realistic one. 7.625 rate, 2.5 discount points and costs. Puts the final APR at 7.742. And you'll see we have dozens of other options here as we scroll down, a little bit higher rates of costs. Some of these may allow other issues such as bankruptcies or foreclosures or other items that would cause us to otherwise not qualify. And some of these may allow us to use a different way to calculate the bank statement income. So dozens, if not hundreds of different options here for our team. Please get with them to find the best one for you. And for our final 2 live demos we do every day, we want to do some investment properties. So we'll set up the same exact scenario, 80% loan to value, 20% down payment. And we'll look at the lowest options for investment properties. For our 2 options here, we'll have conforming conventional options, but the rates are obviously going a little crazy, so probably not going to be realistic to do conventional loans. And then we'll check out our non-QM expanded guideline options. Remember, FHA, VA, USDA, all the government programs do not work for investments. So we'll start with conforming. Everything will stay exactly the same as before. All we've edited here is the occupancy. So we'll see the adjustments that conventional has for investment, and it's going to be pretty spendy. Yep, as the rates go crazy, it just gets crazier. So fortunately, we have our portfolio option with no adjustments. So you see here, 7.125 rate, 3.5 discount points and costs, puts the final APR at 7.375. So great option for our customers that can qualify with conventional guidelines, full doc, amazing portfolio option here. Now, the first agency option, the true conventional option, government insured option, is this one here with the adjustments. So you see the adjustments the government programs have added: 7.875 rate, 5.125 discount points and cost. Probably not even legal to charge that much. That's just way too much, nor would any investor want to charge that much. But unfortunately, with rates going crazy, this is what we have. That puts the final APR at 8.179. So you can see how much the adjustments push the rate up there. So definitely recommend anybody looking at conventional, definitely take advantage of the portfolio version of conventional here, as conventional just goes haywire with the markets. And for our final example here, we'll set up investment property, we'll set back ADLTV, and we're going to check out our investment property options for non-QM, aka expanded guidelines. Now for this option, we do have to select income. The most popular income for investment property, non-QM, is going to be our DSCR option. That's because it doesn't require any income or employment information from our borrower. We simply use the estimated rental income to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITA of the mortgage, aka the property cash flows, that's a ratio of 1.0 or higher. We still have loan options for ratios under 1.0 where the property may not cash flow. For the demo, we always choose 1.5, which is the highest value, so that we can see all the loan options pop up. And finally, a prepayment penalty must be selected for a non-QM investment. We always choose 3 years, which is standard for these programs. There are options for 0, but that will limit what shows up and cost more. There are also options for 5 years, but that will again limit what shows up, but does save our customer some money when available. 3 years is standard. That's what we'll always use for the demo. So let's check the DSCR options today. All right, so definitely a few options here that beat conventional, which is absolutely amazing. Didn't beat the portfolio option, but the true conventionals here. We have a DSCR option, 7.75 rate, 3.5 discount points and cost, puts the APR at 7.900, just under 8. So remember, all the conventional options were over 8 on the APR here. So amazing when we can beat conventional with DSCR. 100% of investors that look at a DSCR next to a conventional and the DSCR is cheaper will choose DSCR. Most investors, when the DSCR is even 1 or 2 points more expensive, will choose a DSCR for the flexibility of being able to do 1, 2, 5, 10 loans at a time with no income or employment information needed. So you can cash out multiple properties to purchase multiple properties, etc. If we scroll down here, you'll see we have a ton of different options as well. Some of these at a little bit higher rates and costs may allow bankruptcies, foreclosures, other issues to slide by, as well as may allow us to calculate income differently. So tons of different options here. Please get with our team. They can find the best one for you. And now let me switch my screen again back to our topic for today, which is totally different than investors, right? Reverse mortgages, not investment at all, right? This is for primary borrowers, 62 and older, that qualify for reverse mortgage programs, which are very unique loan programs, very misunderstood loan programs. So hopefully Jose can clear some common misconceptions. They are great options for people that are in the right situation to take advantage, right? They're definitely not a predatory loan, which is a common misconception. They definitely don't leave their heirs without property, which is another common misconception. So a lot of misconceptions out there. They're definitely valuable programs when they work for the borrower, right? So Jose, if you want to explain a little bit more about, I know it's hard to give examples, right? They're really, it's kind of like a fix and flip loan. You got to kind of have all the info to kind of get the quote, but can you explain a little bit more about what you're going to propose here? I know it's not full examples, but as close as we can get, really.
Correct. Let me touch base on a few more of the misconceptions. Now, the main misconception is that in a reverse mortgage, the homeowner ceases to be the homeowner and they give ownership over to the bank when they do a reverse mortgage. That's simply not true. The homeowner is the homeowner, right? The reverse mortgage is just a different type of loan where the loan itself pays the interest by basically negative amortization, right? You just add the interest to the loan. That is why the reverse mortgage, quoting it really does involve a lot of different variables, right? Involves the age of the borrower, involves the utilization percent of, let's call it, the entitlement that they're able to do. Typically, I mean, the reverse mortgage requirements keep on changing, but typically you're going to be maxing out at approximately 60% loan to value. And in order to get to that maximum loan to value, it increases by age. So the younger the borrower, so if you're 62, just the entry level age, let's call it, for a reverse mortgage, you're going to get a lower loan amount because of the life expectancy, right? This is all based on actuarial tables. So if you're young, 62, you're expected to live to 80, 85. You could theoretically be there for over 20 years in the property with interest accruing, right? And hence, they're going to give you a lower initial loan amount so that there is more of a buffer um, with the property value. Obviously, the property should increase in value every year to try to make up for the interest that is accruing, and that usually is the case. And after and the only time that the loan would have to be paid off would be either if the borrower no longer resides in the property on a full-time basis, like they moved out, it's no longer their primary residence for whatever reason, or they have passed away, and then the heirs get a certain amount of time to pay off the loan, refinance, sell the property, whatever it is they're going to do, right? The property still belongs to whoever it belongs to. It does not belong to the bank. Now, what does happen on some occasions is the property is just so upside down, knows, it's not possible maybe to refinance it, to sell it. So in that case, they just sign the property over to the lien holder, who then sells the property to try to recoup as much of the principal balance as possible. So, and also reverse mortgages are possible for purchases. Now, a little bit of a reduced LTV on those purchases, but it is possible for a purchase, not just a refinance. Uh, the majority of the reverse mortgages are what they call HECM loans, so they are variable rate loan. They're not a fixed rate loan. Now, I'm not going to say there aren't fixed rate options. They are, but they aren't the popular option because the fixed rate loan actually has higher costs associated with it and lower loan to values as well, and less payout benefits. So they really stack the cards against the borrower that wants to get the fixed rate loan. And there are also proprietary non HECM reverse mortgage options out there. Those aren't what we're going to go over today. We're going to go over today the most popular option, which is going to be an FHA reverse mortgage. So it does have FHA, upfront mortgage insurance, involved in the mix. There is a monthly premium that is taken into consideration also in the payment. However, remember, none of that is paid out of pocket by the borrower. It's all covered by the property. Now, or should I say a couple of very important points to note, though, is that the borrower is still responsible for paying property taxes, for paying property insurance as applicable. Obviously, if it's a property where they got to pay it and it's not a condo or anything like that. So they do have to cover their own property insurance as required, their own taxes, and property maintenance. So if it does, now property maintenance is actually a requirement on all loans. where if you don't maintain your property, the bank can foreclose, right? If it's all beat up, needs a roof, needs a bunch of stuff, you're affecting the value of the collateral. Theoretically, they can foreclose for that. But the two items which can tend to get the reverse mortgage borrower in difficulties is the fact that they still need to pay the taxes and the insurance, and in some parts of the country that could be a pretty substantial amount. And there is an income requirement. It's not like back in the days when it first came out. There is some type of residual income that they need to show to cover their basic living expenses, right? Because what's the sense of giving you this loan, keeping you there if you can't even afford to eat, much less pay your taxes and insurance? So keep that in mind. So,
Hey, Jose, real
yeah,
quick, a big misconception too here is that they can't make a payment. Understand that they can make a payment just like any other mortgage. It's only going to amortize negatively if they don't make the payment, right? So they what they're getting is to have no obligation to make a mortgage payment. So you could even have a senior that doesn't necessarily need a bunch of cash right now or anything, but they do the reverse mortgage just in case they want to stop paying the mortgage payment to cover other costs, right? So that's also a big misconception, is that they're locked into negative amortizing forever and they can never gain equity in the home, but they could keep making payments just like normal.
correct. I would consider the reverse mortgage like a security blanket. Besides the fact that they're going to get some money, usually depending on their equity position, but yes, it is a security blanket in case they decide, for whatever reason, they want to budget so they don't have to make the principal payments, or maybe they don't want to make the principal and interest payment. Depends, however, they want to budget themselves. So they can make just interest only if they want, or the full payment, or a combination thereof to control the negative amortization. That is a great point. So let me share some examples with you here now. I got a few purchase examples, and then I got a few refi examples. Let's go with those first, and then we go with the purchase example. Now, the one thing that is going to change the rate on the and the cost, or the loan cost on the reverse mortgage loan, is going to be the margin, right? That's the rate is based on a monthly adjustable rate loan, whatever that index may be, plus a margin. That's going to determine the fully index rate on which the interest is charged to the account. So obviously on these loans, if there's a higher margin, there's a higher payout on the loan, and that um, then decreases the loan cost. And if there's a lower margin, there's a higher cost on the loan, and that increases the loan cost. So here, the what I would probably call, and I'm doing this example at a 60% LTV, which is pretty much the max. The other thing to note is that the rate can also vary based on the loan utilization, right? So if you're 62, or let's say in this example, let's say our borrower is like 80 to be able to get the 60% LTV, but you decide you don't want to go 60%, you can do fine with 50% of your loan instead of the 60%. You're going to have a lower loan cost. That's, I guess, would be similar to being at a lower LTV in a standard loan. Here is just called the lower utilization, I guess, of the max benefit, max allowable loan amount, which results in a lower cost. Here I'm maxing them out at 100% utilization, which is what most people usually want. And this would be the par rate today, would be a start rate of 7.775. And remember, this is a monthly adjustable rate loan from the beginning. There is no 1 year fixed period or anything like that, so it will adjust on a monthly basis. So here, this is our par rate, 2.375 margin. So now 2.25 margin, you'll see the rate basically is tracking the margin, 7.65. And now we have zero point 0.3 points cost to reduce the margin. And really what it does is the payment is like $30, 26, $28, something like that. Uh, Now, our next option would be, now there are higher margins than 2.375, which does result in a higher payout. But remember, it's a balancing act. You're going to be proposing the loan to your borrower. They're going to be analyzing it just like any other loan, and they're going to be looking at their rate. So if the rate is too high because you put too high of a margin because you wanted to make more money, you could end up with 100% of nothing because you may not get that loan. So it is a balancing act. So here, 2.125 margin, right? Now we're going a little bit lower. Notice 0.925 in points at a rate of 7.525, dropping the payment like another $26 on that one. And then here we have 7.4 rate at a 2% margin, 1.525 points. And here we're assuming fully amortized payment here now at 2113. That's not interest only. And then 1.875 now does get a little bit more expensive now. Just to drop that other 0.125, you do jump like almost 3/4 of a point in cost. So it really has to be worth it. 7.275 rate at a cost of 2.225 with a margin of 1.875. And final example here, I'm just showing you a purchase example. This is at 50% LTV, maximum utilization. And again, that would be our par rate, 7.775. So I do emphasize that when you are quoting these, it's not simply going to a rate sheet. You're usually going to have to go to some type of account of reverse mortgage type scenario calculator where you're going to have to put in all of the specifics of the deal to then obtain the interest rate options for your borrower, which then you share, and they will decide how high the LTV they want to go. But most people want to max it out.
Got a question from Richard here. So also another thing that we didn't mention before, all reverse mortgage applicants have to go through counseling first. So they're going to be counseled on this. And then once they're counseled, we can issue their package, which will have their full amortization table, negative am, and all of the warnings and layout of everything, right? So again, it's really complicated to get those quotes together and give them out their full package. Once they do, they'll have all that information there, Richard. So you're exactly right. They won't be able to make a decision without that. So that's what we provide them as part of their. It's not a traditional loan estimate, right? It's not a traditional disclosure package. It's specific for reverse mortgages.
The one thing to note is there is going to be compounding on the negative amortization, right? So you're going to be paying interest on interest on interest.
All right. I don't see any other questions. Now, I did a sales training on this a few days ago. And remember, as far as a loan officer talking to a client about this is a perfect product for people who want to spend the rest of their days enjoying the benefits of the equity in their home and not having to make a payment. And it's going to be for the right person, right? So this is very much a product you need to talk to people about, consult with them, and see if it's right for them. Because if it is right for them in their situation, it's an amazing product for people to be able to not only have money to spend, but also not have that obligation to make their payments, so they can spend their money in their final years the way that they would like to. Or nowadays, a lot of people can't even retire when they're 60, 65, 70. People are still working. And this usually would allow them to do so between, any retirement they have, Social Security, and then not having to make that mortgage payment can allow people to maybe retire when they couldn't, or take the vacations they want, or spend the money on the grandchildren that they want, and all that kind of stuff.
And I could add, it could simply allow them to stay in the home where they've been there, for the large part of their adult life, possibly in some cases, the home that they're used to living in, the rhythms, the patterns that they're used to, and not having to cause disruption in their life, which could shorten their lifespan simply because they can't afford to make the payment anymore.
Absolutely. Okay, is there another question here? No, okay. All right. Well, let's go ahead and wrap it up then. Remember, we do this 11 a.m. Eastern every weekday, where we go through the live rates and then do a deep dive into a different topic. So we'll be back tomorrow with a new topic. Thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. We'll see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Have a good day.